and forth between Rockville, Maryland, and Orlando, Florida. So super excited to be with you all. And I guess as just a kind of quick introduction to my, um, I guess, attachment or how I got to be associated or in touch with the IACC. My wife, Donna Mogadam, is Persian, and over the last 5 years of being with her, I've become quite um, entranced by the culture and learning, about the Iranian and Persian culture. So it was when I got the email asking for, expertise, I was eager to share in whatever way I could, and this is kind of my domain. So I am really excited and honestly a bit more nervous than I am for most presentations. So I'll ask you all to bear with me, especially as I'm sitting down. So I may be swiveling a bit as I go. But what I'm planning on sharing with you all today is goals-based investing. So the kind of overarching theme of today's talk is going to be less about what should you invest in, what shouldn't you invest in, and it's going to be more philosophically how we approach investing at really all stages of life. So goals-based investing is going to kind of transcend life stage, where some folks might be closer to retirement, some folks might just be starting out. This will be somewhat agnostic to that and more based on the principles. So as I go through, I am very much open to questions as we're going. There will be time at the end to ask them, but this is very much your all's time, not mine. So if there are questions as I'm going, feel free to use the chat, unmute yourself, whatever's most convenient for you. Um, but just to kind of give you a quick overview of what we're going to be covering today. So I'm going to share some statistics about investing and kind of how that has proliferated in everyday life for most people. Going to talk about cash flow and goal clarification. This is the driver of financial planning in general, but certainly going to be the most kind of important piece of establishing investment strategy. Then we'll define what is goals-based investing and what are the components that contribute to that. I'll touch on a savings waterfall, which is going to be how do we prioritize the dollar? We have a limited number of resources. Where do those go, and in what order and why? And then we'll go into a couple of principles in investing around diversification, tax diversification, and risk. Okay. Um, and as I mentioned, Matt Pisera, financial planner, among other things, and my firm is Aether Financial Group. But some quick stats. So first thing that I like to share here is in 1952. So if we kind of look at the history of investing, S&P 500 goes back to about 1926, something to that effect. But in 1952, only 4.2% of Americans owned stock. And that number creeped up to 20% by 1990. And today, that number hovers around 60%. And the reason that I share these statistics is because I think it's very easy to miss the fact that everyday investing is a relatively new concept. This is not something that's been around. Money's been around for a long time. Investing has been around for a long time. But if we go back 2 generations, most people were not participating in any sort of formal investment strategy or the stock market or anything like that. And so this is a new field that we have to kind of learn and navigate as we go. I also included a note here down at the bottom. IRAs, individual retirement accounts, are only 50 years old. The tax code has only allowed them since 1974. And so this is just something that it feels like we are very ingrained in it. And there's reasons for that I'll share as we go, but it's relatively new. It's relatively new. And then the last point that I always like to kind of add here, retirement as a concept that we strive for, also very new. If you go back 100 years, retirement was synonymous with being obsolete because we just didn't live that long and we had pensions and all these other things. But now it's something that we have to plan for, we have to save for, and using these financial tools and strategies that we talk about is a way to kind of do that in a really efficient way. Morgan Housel, one of the kind of most well-respected writers on finance right now, has this quote that I love. There are two things every self-respecting adult has to have a basic grasp on, whether they're interested in them or not: health and finance. And I think that that is incredibly true. Whether we do like it or not, whether it's new or not, whether it's natural or not, we are all in this financial system, and we have to understand how to navigate within it. And so, at the core of financial decisions is cash flow. This is very, very basic, but this is so important no matter how much wealth you do or do not have. Understanding how much money comes in and how much money goes out is going to determine what goals you have the capacity to achieve or address, and how you go about that. So, in a more modern look on cash flow, investing, etc., there's this balance between current lifestyle and achieving your financial goals. And I think that gets lost a lot in mainstream kind of financial news, because there's either, this, you only live once. There's this kind of, I want to enjoy my wealth now mentality, or there's this very much delayed gratification where we're maybe over constrained. We have a somewhat unhealthy relationship with money now in pursuit of, hey, I'm going to enjoy it later. And so finding that balance between, hey, I work hard for my money, I want to enjoy it, but there's also these things that I want to achieve that aren't immediately available to me. And saving for those is kind of at the core of goals-based investing. And then aligning the use of your resources with your values. And I think that's true, whether it's finance or anything else, really. Kind of understanding what it is that you value and using resources, whether that be money, time, energy, attention, whatever it is, in a way that is kind of lined up with those values that you hold close to yourself. Um, and this kind of quote highlights that, right? So the price of anything is the amount of life you exchange for it. So, taking inventory of how much life, how much energy we are expending is kind of determining how much, that thing is worth to us. So, goals-based investing. So the components of goals-based investing, the reason that this kind of transcends any sort of, our age or our life stage or anything along those lines, is it's about what the purpose of those dollars are. And so at different stages of life, we may have different goals that we attach to our investing strategies, whether it's buying a house, saving for retirement, buying a business, fill in the blank, but the principles are going to be the same. So purpose is number one, and that's something that, we'll spend a little bit of time talking about. But purpose is one, risk, asset allocation, and then tax diversification, which is something that is a little bit less mainstream. I think, we've gotten really good about talking about risk tolerance and things of that nature. Asset allocation is another one where we at least know the term for the most part, but understanding the role that taxes play in investing is something that I think gets lost a little bit. And just like fees, taxes are, basically a drag on our performance. And we've got to understand what that looks like depending on what the goal is. So as we establish our purpose, this will change depending on where we are in our financial lives. So what I have pulled up on the screen is called the savings waterfall. There's a couple different versions of this, but this is the one that we've put together. And what this is designed to do or designed to show is, if you only have a dollar, where do those dollars go first? So how do we prioritize our savings? And so I'm going to explain the waterfall quickly, kind of highlighting a few of these different tools, and then we'll move into the more technical investing component of this. But the first one up there is an emergency fund. Emergency fund is safe, liquid money that you keep on the sideline in case something goes sideways, right? Periods of unemployment, periods of lesser income, unexpected expenses, et cetera, et cetera. Typically, an emergency fund should be 3 to 6 months of expenses in a safe liquid place like a cash, money market account, high yield savings. One of the things that's really important there, it is 3 to 6 months of expenses, not income. That's a pretty common misconception. You want to make sure that you're prepared for the expenses that you typically incur, regardless of how much income you necessarily have coming in. The next one is 401k, which we'll kind of use as a proxy for employer-sponsored retirement plan. So 401k or employer-sponsored retirement plan to the match. And so oftentimes, if you have access to a 401k or a 403b or another retirement account, your employer may offer a matching contribution. And these are free dollars. So sometimes they say if you put in 5%, we'll match you 5%. Sometimes it will say if you put in 5%, you'll get 2.5%. Regardless of what the rules are, you want to make sure that you are contributing up to that matching contribution because it's free money. It's a guaranteed 100% rate of return. Okay. Once you move past there, paying off high interest debt, it becomes the next priority. We typically define this as anything greater than 10% interest. You should prioritize paying that off. And the reason being is in order for you to put your dollar somewhere else and for it to make financial sense, you have to earn more than whatever interest you're being charged. Okay, so if you have a credit card at 25%, you have to earn 26% in whatever you're investing in order for that to have any sort of financial feasibility. But paying off interest is also guaranteed when you do it. And so you've got to factor in the risk, which we'll talk about more later, associated. So paying off high interest debt would be next. Then moving into Roth IRAs. Roth IRAs, which refer to the tax treatment of that retirement account, are a very valuable tool to many, many people. Not everybody is eligible outright for a Roth IRA. And so a Roth IRA, the income contribution limit somewhere hovers around 164 to 200,000. There's kind of a phase out range. And so if you are making less than those thresholds, you can contribute up to $7,000 to a Roth IRA. We'll talk more about the benefits of that in a little bit. If you are not eligible based on income, you can do what's called a backdoor Roth IRA. So regardless of how much income you make, there is an effective way to get money into Roth accounts. But the reason that we use Roth accounts is because they create tax-free dollars in the future. So this will be something we talk more about when I get to tax treatments. But Roth IRAs are going to have tax-free dollars in the future, depending on where you think your tax bracket will be, your income will be, et cetera. Will kind of dictate how much value you place on that or not. Next one, health savings account.
Matt, can I
This
ask
is
a
some,
question?
you
Sorry.
sure can, please.
Um, so I feel like a lot of people know about the difference between Roth and traditional, but like since I've started working, there are like few people that will be like, you should really put your money in a Roth 401k, which I feel like I never knew about until people say that. And like it's set up, like the way it's set up for you at most employers is like traditional. And I'm like candidly just too lazy to change anything. But like so many people have told me that I'm like missing out on like basically everyone should be in a Roth 401k. So I was wondering if you had any, I think you're going to get to tax later, but if you had any advice on that and if like a lot of your clients know about like the Roth 401k.
Yeah, awesome. I love the question. Thank you. So I will actually, I'll touch on that. So to first level set, when we talk about Roth versus traditional, we are talking about when do we get our tax benefit. So traditional accounts, you take a tax deduction on the contributions that you make today. The money grows and grows and grows. And then when you take it out after 59 and a half in retirement, it's taxable as ordinary income. With a Roth account, it's the opposite. There's no tax benefit to putting money into a Roth today. But you contribute, the money grows and grows and grows. And then when you take it out in the future, all of the money from a Roth is tax-free. And so when we're deciding, and there's two parts to your question, Hannah, that I'll try to touch on. When you're deciding which one to contribute to, there are at least two factors that weigh in. Number one is your perceived future tax bracket relative to your tax bracket today. So at a very high level, if I think that I am in a lower tax bracket today than I will be in retirement, I want to essentially give the tax break to my future self. And to do that, I contribute to a Roth. So if I think I'm in a lower tax bracket today than I'll be in the future, I want more Roth dollars now because my future self needs the break more than I do today. And if I think I'm going to be in a lower tax bracket today, so if in my peak earning years, it would be the opposite. Now, the benefits of a Roth 401k or a Roth 403b or whatever you have access to, if you do, number one, there is no income limit. So you can make $1 million a year and still contribute to a Roth 401k. And the contribution limit is significantly higher. So where I can only contribute $7,000 to a Roth IRA, I can contribute up to $23,000 to a Roth 401k. So the only reason that somebody who is maybe early stages career would not contribute to a Roth 401k would be if their employer requires them to contribute to the traditional to get the match. That's less common now, but that's possible. So oftentimes they'll say, you can contribute to whatever you want. As long as you're contributing, we're going to match your contributions. If they say, you've got to contribute to the traditional to get the match, you would do the traditional first. And then all those additional dollars would likely go towards that Roth account, if that makes sense.
So basically, if technically your employer would match regardless of the type of account, the only reason why you wouldn't do this at like, sorry, I'm just going to cater this to myself, at the age of 24 is if like you thought you couldn't max out your account with after-tax dollars.
Yeah, correct. Yeah.
Okay.
So as a young person, it's a pretty, and I would say this applies to probably anybody who's 20s, 30s, mid 40s, even as like a blanket statement, and anybody above that age, it just gets a little bit more nuanced. But the second piece of this, which I think is valuable to consider no matter where, what life stage we're at, when you think about your future tax bracket, most people immediately think about income, right? So in my peak earning years, in my early stage earning years, am I tailing off in my earnings, et cetera, et cetera? And your income will dictate your tax bracket. The other thing that we have zero control over, but is highly relevant, is tax brackets or tax rates based on essentially policy changes. And so we are in a relatively low tax environment today, with the highest marginal bracket being 37 and change. There was a 50-year period in the US where the highest marginal tax bracket was at least 60%. And so it is very likely that in the future, tax rates will be higher than they are today. So even if we're making the exact same amount of money, we might pay more in taxes later on. And that's a really great kind of point to make. So yeah, for the most part, unless there was something anomalous where you would actually be dropping a tax bracket by contributing to a traditional account, you're typically going to look towards Roth accounts. And not for nothing, if you are under the income thresholds that I shared, you can contribute to both a 401k up to the max and a Roth IRA up to the max. So that's a little bit less common because that would mean we're trying to save upwards of $30,000+ a year, but you can do both.
Thanks, Matt. Helpful.
Of course. Thank you. Any other questions or anything else kind of in that line that we want to kind of flesh out while we're here? No. Okay, perfect. All right. So then kind of following on down to our next health savings accounts. Health savings accounts are not widely talked about in my opinion or experience. So a health savings account is only available if you have a high deductible health insurance plan. But if you do, you may be able to contribute to an HSA, health savings account. What's so unique about HSAs is that they are one of the only vehicles, at least we'll say legal vehicles, that could offer triple tax-free dollars. And so what that means is that you can contribute to these accounts and take a deduction for the contributions. The money can be invested and can grow and grow and grow. And if you take the money out for qualified healthcare expenses, that money is received income tax free. So in theory, you can use an HSA and never pay tax on the dollars. Now, HSAs, like I said, you have to be covered under a high deductible health insurance plan, and there's contribution limits associated with them. But if you, for some reason, contribute to this account and you don't have enough qualifying healthcare expenses, there's two things that you can do. Number one is if you get to normal retirement age, you can take the money out of your HSA without a penalty, and you'd only be responsible for the tax. And so it would work just like an IRA does. However, what's really unique about HSAs from a reimbursement standpoint is there is nowhere in the tax code that says you have to take your reimbursement in the year that your medical expenses incurred. And so in theory, if you have an HSA, you can pay your healthcare expenses out of pocket for 10, 15, 20 years. And as long as you have some sort of method for keeping those receipts, you can let the money grow and claim the reimbursement in a lump sum later on in life. And so there's a ton of arbitrage opportunity there. Again, a little bit more niche. You can only put in, I believe it's around $3,500 a year, depending on whether it's for an individual or family. But HSAs are a really powerful tool for those of us who are eligible. Moving from the HSA, we then move in back into the 401k or the qualified plan space. Like I said, these have contribution limits of up to $23,000 for 2024. There is a $7,000 catch-up contribution that we unlock after age 50. And so if we're over age 50, we can put in up to $30,000 to a 401k plan as a W-2 employee. And once we've done that, so once we've taken advantage of all of these tax advantaged types of accounts, we then move into after tax savings, which would be like a brokerage account or a high yield savings or a money market or something to that effect where it's not retirement specific. We're not doing it for any tax break, but we're growing our money in a way that we can use it for our goals later on. So those are kind of the high level what these things are and how we progress through this waterfall. But as we kind of sift
I have a question
through.
about
Oh yeah, absolutely.
I'm saving up for a down payment. Do you suggest just saving it in high yield saving accounts, or do you suggest that putting Roth because you can take it out anytime that you want, at least your contribution?
Yeah, great question. So part of that's going to depend on the time horizon and the flexibility of it. If you're thinking, and I'm going to create a hypothetical and we can tailor it a little bit more. But if you're thinking, hey, I want to buy a house.
So like, yeah, I'm looking in buying a house like in 3 years. So that's kind of the horizon that I'm around.
Gotcha. So what I would say is that at a high level, most of your money should be going towards some sort of high yield savings account. And I'm going to make up a threshold and say 80% of your savings should go towards something like high yield savings where there's really no risk. You're getting rewarded for your saving, but only modestly so. And then that 20% you could put towards a Roth, but because you can only take your contributions, you're not actually benefiting from the growth in that. I would probably lean towards using a brokerage account, so an after-tax savings account where you're investing the money. And the reason that I say that only 20% or so should go towards that type of tool is because if the market does well or your investments do well, you're getting that little bit of a tailwind. But if the market doesn't do well, you don't have very many eggs in that basket. But you can't, as you said, you can use a Roth, you can take out your contributions, but if the goal is to buy a house, I would probably lean towards high yield savings in a brokerage account.
Perfect. Thank you.
Yeah, thank you.
And I have a question. So I work for the government, the county, and we don't have 401k. We have 457b. What is the price of that type of plan in this chart? Is it instead of 401k? And
Yeah.
go ahead.
Oh, was there a second? Go ahead.
Yeah,
Ask the second
and
part.
the other part of my question is maybe you touch it later, but what type of fund should we decide for our retirement investment? For example, my retirement plans offer the age-based plan that, for example, if
Mhm.
yeah, they use risky approach now and move towards safer approach in future. Also, you can use something like, I don't know, S&P 500 and diversify. And do you have any recommendation about that? Thanks.
Yeah, perfect. So to address the first question first, do you have access to a 403B or just a 457?
457B.
457. Okay, 457B. So 457B is going to work just like a 401k. So same tax properties where you're going to get a tax deduction for the contributions that you make. To my knowledge, there are no Roth 457 accounts, and so you won't have an employer-sponsored access to something like that. But you would be using your 457 in the same way that the 401k is listed here. Um, it's not uncommon for government employees to have access to a 403B and a 457. So I'd be curious to just kind of confirm that you don't have access to both. But if you don't, the 457 is going to kind of take the place of the 401k in this example.
And since there is no match, any percentage is ideal.
Yeah, so that's another great, yeah, because I was going to say 457s typically do not have a matching contribution. And so when you don't have a match, your incentive to use the employer-sponsored plan does go down, but it is not gone. And the reason it's not gone is because your 457, your 401k, your 403b, even if there's no match, is going to be your largest contribution limit for tax benefited dollars or tax advantaged dollars. So there's no other tool that you're going to have access to necessarily where you can take as big of a deduction for the contributions that you're making. The one thing that I do want to throw in here, because I feel like I have glossed over it, these tools that I'm sharing are the primary tools available to what I'll refer to as W-2 employees, so employees of companies. If anybody on the call is self-employed or has self-employment income, A, there are different tools available to you, and B, there are typically different contribution limits available to you as well. So that's an important caveat to what I'm sharing, but the concepts will hold as far as the tax treatment and everything along those lines. So Amir, where I would say is even if there's no match, these are still tools that you're likely going to want to take advantage of, depending on how much money you're saving and how much money you're saving for retirement specifically. When you get into investment decisions, we're going to feed into that statement a little bit more, but at a very high level, target date funds, which is what you're referring to with those dates, those are very efficient tools, and these are usually accessible to most participants in 401ks, 403bs, where if you look at the investment, it says retirement 2035, retirement 2060, retirement 2055. And what that date is supposed to do is it's supposed to align roughly with when you plan to retire. And so what those funds automatically do is as that date gets closer, the risk scales back. So target date funds are a way for you to A, be diversified, B, have a risk adjusted approach, and C, kind of have the closest thing to a set it and forget it plan that you can, because the investment manager is automatically going to scale back the risk based on when you say you want to retire. And so if you are a conservative investor, that might not be the best tool for, well, if you skew, maybe a better way, if you skew aggressive or if you skew conservative, a target date fund might not accurately capture how you should be invested. You could technically choose a different date So you could say, hey, I'm going to retire in 2050, but I'm really aggressive. So I'm going to pick a 2065 fund, because the longer that date is away, the more aggressive the fund is going to be. Then you do get into the conversation about, do I just use some index funds that are available? The tricky thing about this question is all of these plans are A, going to have different offerings for the most part, and B, they typically have fairly limited offerings. So when we're in an employer-sponsored plan, we don't have the entire investment universe at our disposal. We have to choose from kind of this preset menu. And so when we're picking off that menu, it's not just about what funds are going to be available in terms of like what their risk objective is. It's also going to be what the costs associated are. So using a target date fund is usually a fairly low cost way to invest. So is an S&P 500 fund, but you do have to be a little bit conscious of what are the fees associated with the different investments that are being offered. So that's not a great way to answer your question, but hopefully the rest of the talk will give a little bit of more insight and kind of flavor to how you would go about choosing something like that. Yeah.
Thank you.
Oh, I think you're on mute.
So when we choose our 401k and we choose those different things, I was never aware that there were different levels of fees. That's interesting. How do you see those fees? Are they on your report or are they hidden fees?
There's not necessarily hidden fees. That's maybe not the right way to say that, but there's typically two layers of fees that you have to be aware of. So there's fees that can be associated with the wrapper that these funds exist in. Those ones are usually a little bit more transparent. And so you're talking about, hey, this account has a 1% management fee, or it has a 0.2% management, or whatever that fee associated with kind of the account ends up being. But then what happens is you're investing in all these funds inside of it. And so I'm choosing a Vanguard S&P 500 fund. I'm choosing a PIMCO total market or total bond return fund, et cetera, et cetera. Those fees, you have to actually go and look at. So you can Google it. If you Google the fund name, you'll be able to find it as long as you choose the right share, and it'll have an expense ratio that you can see. Usually index funds are very low fee. So think 0.05% to 0.3%. Actively managed funds might have a higher fee, which could be anywhere from 0.8% to 1.2%. But looking at those different layers of fees, I think are I think important, because those fund fees are less transparent. To the point about hidden fees, the individual fund fees will be slightly less transparent than the account fee would be. And then they'll always be in the prospectus, although those are 100 some pages long and most people don't read them.
Oh, thank you. That's good to know. I'm a little
Yeah.
old for that, but for young people, they can look out for it. So
There you go. Absolutely. So looking at those different types of things. And again, I think for most people, index funds are going to be a great tool to use. There's, a long held debate between active versus passive. Passive has kind of taken the lead on that in a large way. So you don't typically need to have an actively managed fund with a high fee, depending on kind of where you are in your investment cycle, things of that nature. But that does kind of transition us into choosing investments is going to come down to a number of different things, but one of which is risk, right? So understanding how much risk I am willing or wanting to take to achieve whatever financial goal I'm setting for myself. And so there's these two different risk metrics that I think are so important. And only one of them gets a lot of headline space, which is risk tolerance. But risk tolerance relates to your, I'm going to say, emotional or psychological ability to handle ups and downs in the market or ups and downs in your investments. So somebody who has a very high risk tolerance is essentially saying, I am trying to earn as much money as I possibly can. And I'm comfortable with the fact that the market goes down. And when the market goes down, I'm going to participate in that downside as well. So I like to think about risk tolerance as, I'll pull some of my Orlando in me. If you think about rides, right? A high risk tolerance is like, I like roller coasters. So I'm comfortable with the ups and the downs. A low risk tolerance says, I'm not concerned about making as much money because I really just don't want to lose anything. And so that might be like the teacup ride, right? Where I'm not really experiencing a whole lot of volatility or ups and downs. And then there's anywhere in the middle. But your risk tolerance is that emotional ability to not be deterred when you experience volatility. Risk capacity is a more mathematical function. Risk capacity says, given my age and my time horizon, how much risk can I take and reasonably meet my goals? And so sometimes these two are in sync and sometimes they are not. But a good example of risk tolerance versus risk capacity would be somebody who is very concerned about market volatility. So when the market goes down, they are very kind of emotionally or psychologically affected. And their risk tolerance says that they can only invest in very safe tools. And I'm going to make some numbers up. And let's say that those safe tools have an average rate of return of 4%, right? Today, that's very low because our safe tools have a pretty decent yield. Historically, that would actually be pretty reasonable for a bond type of allocation. But this person needs realistically to earn 7% in order to retire with the lifestyle that they want to retire with. So they have a mismatch because their risk capacity says they need to be more aggressive than what their risk tolerance is. And so there's no right or wrong on this, but understanding how those two contribute to the investment decisions that you're making are both important. And the opposite could be true. You could have somebody who has a very high tolerance for risk, but only needs to earn a very modest amount of rate of return. And so not taking risk you don't have to is also part of this decision. But that emotional ability to stay in the market and that mathematical ability to understand what do you actually need are both going to contribute to how much risk somebody should be taking and setting your expectations against that, which is important. So this is one of my favorite pieces. This is from JP Morgan's Asset Management Annual Report. And so what this captures is data from 2002 to 2021. And it shows what is the average rate of return of various assets or vehicles. And so the bright green bar over on the left-hand side of the screen is the S&P 500. So if you bought the S&P 500 in 2002 and you held it all the way through 2021, you would have averaged 9.5%. Okay. So if I'm a very risky, aggressive investor, and I can stomach the fact that I would have lost 40% in 2008, and I would have lost 30% in March of 2020, and I would have lost 18% in 2022, which this doesn't capture. If I can stomach those downs, I would have come back and I would have earned an average of 9.5%. Then you look at these blue bars in the center, which say, you know what, I want to earn a reasonable rate of return, but I don't want to participate 100% in the ups and downs. And so a 60-40 portfolio, meaning 60% stocks, 40% bonds, would have returned 7.4% over the same time horizon. 40-60, 6.4%. So basically saying, hey, I'm giving up some of the upside, but I'm also not participating in 100% of the downside either. So understanding, risk tolerance and setting your expectations against it is important. But the other bar that I like to highlight on this screen is the kind of orange one, which is second from the right, which is the average investor. And the average investor only earned 3.6%. So I could have bought the S&P 500, not looked at it, earned 9.5. I could have held a 60-40 portfolio, earned 7.4, but the average investor earned 3.6. And so there's probably many different explanations for why that is, but the two most salient are, in my opinion, fear and greed, right? So most of the average investor's challenges are behavioral. They're not, I didn't choose, to invest with the right company. It's not even really that the fees were too high or too low. It's that I made poor decisions, whether it was chasing return or whether it was getting out at the wrong time, but I made poor decisions and I didn't give myself the ability to participate. And this is the emotional wave of investing. This is a fairly, I think, kind of common visual for the waves and the roller coaster, etc. But one of the things that I think is so overlooked when we talk about, and I guess I'll speak to fear first. So fear is when the market goes down by 40%, I can't stomach it, I sell, and I don't participate in the recovery. History says the market's going to recover, right? Doesn't mean it always will, but it hasn't not done that yet. But there's a different feeling when you lose 40% of your wealth in a year. And so we think about that, and you think about 2022, you can think about, again, I say March of 2020 was a good example. I'll kind of double on that in a second. You think about 2008, these are years where the market was down, okay? On average, the market is down about 25% of the time, not quite. So 1 out of every 4 years, 1 out of every 5 years, plus or minus, the market is actually down, which means that 75% of the time or more, the market is up. However, what we need to keep in mind is that the market doesn't just go up in a straight line. And so I love, and this is probably the wrong way to phrase it, but from an example perspective, I love 2020 because if you had, I'm going to use two examples. If you had $100,000 in 2020, January 1st, 2020, in March of 2020, you had roughly $66. So the market was down about 34% in March of 2020. Okay. But if you didn't do anything and you held it all the way until December 31st, you would have had 116,000. So the market finished up 16%, but somewhere in the middle, it was down 34%. And so it's not just the years where the market is down that we need to be able to stomach the volatility in the market, right? Because you could have closed your eyes, 100 would have turned to 116 and you would have been happy. But if you got caught up in the kind of COVID nonsense that had an impact on the markets, you could have sold 30% down. And what this chart kind of not so visually well shows is that most years the market fluctuates more than 10%. And so almost every single year, you will have to be comfortable with corrections that are temporary in nature. Okay, so understanding this, at least conceptually, hopefully gives us a little bit more ability to stomach the ups and the downs. But we do have to be really aware of it because the fear-based selling is a very real thing. The second half of that equation, greed, which we do not have a slide for, so I'm just going to talk to it. That's the whole concept of chasing returns. And so, Bitcoin is a good example of it, right? Not that Bitcoin is good, bad, it's indifferent largely, but when you start to put a disproportionate amount of wealth in a risky tool because everybody else is doing it or because there's a lot of news about it or because you think you should, you expose yourself to disproportionate amounts of loss. And so we'll get to diversification in a second, but this concept of trying to find the next hot investment or trying to choose the perfect tool, professional money managers don't do it very well, let alone lay investors. And so making sure that you are measured in those decisions that you're making can go a long way. Because again, a diversified portfolio is going to outperform 99% of the time. But, you know, it's easy to get caught up in this person, that person, my neighbor, you know, made however much money they made in some tool, and I got to get into. Okay. So the behavioral piece, that greed and fear, are two things that you really have to be conscious of as you participate in the market. This is a very messy chart. I'm not going to talk to it. Just know that the colors are in different places every year. And what that means, oh, I guess I got to stick on it for a second. All that this means is that different asset classes, which are represented by the different colors, do well in different years. There's no block that is in a straight line right across the board. So when we start to think about chasing, we've got to understand that what did well is not necessarily what will do well. The market is cyclical. Large cap stocks will do well, and then they will do less well. Small cap stocks will do less well, and then they'll do more well. And so the concept of diversification is saying, hey, I'm not going to try to pick which one of these things I should definitely be concentrated in. I'm going to own some of the big asset classes, and I'm going to absorb some of the gains, some of the losses in a way that is more measured. Okay, so diversification, I think that one is kind of commonplace at this point, but it is important among asset classes. And then we get into the tax buckets, which we've already now talked about a little bit, but tax deferred, taxable, tax free. So just to kind of reiterate what these mean, tax deferred are your 401ks, your 457s, your IRAs, your 403bs, your SEPs, your simples, anything that doesn't have the word Roth in front of it, any retirement account without the word Roth. And so again, the way these work, I put money in, I get a tax deduction today. The money grows, grows and grows. When I take it out after 59 and a half, I am taxed at whatever my ordinary income rate is at that time. So these tools are really, really great for high income earners who are in their peak years, potentially peak years, and they're most concerned about taking a tax deduction now. You know, as I mentioned, in 2024, you can put in as a W-2 employee, you can put in $23,000 on a tax deferred basis for if you're under the age of 50. That number jumps to 30,000 with catch-up contributions after the age of 50. If you are self-employed or you have self-employment income, you can contribute up to 66,000 to these types of accounts or more if you're choosing to use a defined benefit plan. But the tax deferred usually going to be most advantageous when we're in our peak earning years and most looking for a tax deduction. Tax free, so going to jump to the other end, that's the Roth. So anything with a Roth in front of it, municipal bonds and cash value life insurance also fall into this category, but tax free dollars, no tax break up front, money grows and grows and grows. And when I take money out at any point in retirement, it's income tax free. Okay, so this is typically going to be best for the person who's in their earlier stage career or the person who just thinks they'll be making more money in a higher tax bracket in the future. And then you got your taxable accounts, and this is what people refer to as either retail account or brokerage account. These are the non-retirement goals. So things like buying a house, things like buying a car, things that are nondescript, especially for the younger folks. Like you probably have a lot of goals that are not retire. And so anything that's going to happen between now and then, you want to have in a taxable account where you're not getting a tax break for the contributions. You're not necessarily getting a tax break for the distributions, although there is a difference between income tax and capital gains rates. So capital gains rates are typically more favorable, especially if you hold the investment for more than a year. But these are the types of accounts that fuel lifestyle. And they allow you to kind of enjoy and grow your wealth in a way that, again, doesn't just mean I get to retire. And this is also really important for anybody who's maybe looking to retire earlier than 59 and a half. You need to have some of these taxable accounts, most likely, in order to fund your lifestyle before your tax deferred accounts become available. Okay. So there we go. With that, you know, about 4 minutes left, and I'd be happy to take any questions if anybody has them, or clean up anything that I didn't explain particularly well.
I have a question. Uh, so between maxing out your retirement account or, for example, investing in stocks like S&P 500, do you have any recommended balance? Because if you max out your retirement, that money is kind of locked until you reach that age, and if some opportunity arise, you cannot
Yeah,
put that money easily.
absolutely. So Amir, you bring up maybe two or three things that I'm glad you're poking at. Number one, and this is I think important just for context. There's nothing magical about the contribution limits to a 401k or a 403 or 457. The IRS never sat down and said, if people do this, they're going to retire comfortably. They just said this is the maximum amount that we're going to give them a tax break on. And so depending on where you are kind of in the earning spectrum, you might need to save more or less than what the IRS limits actually are. For most people, depending on when you start saving, that number is between 10 and 20% of your income for retirement. So depending on when you start, you should be saving somewhere between 10 and 20% for retirement, regardless of where that falls in the deductibility, et cetera, et cetera. However, Amir, to your point, where do I save in a way that is not geared towards retirement? So I think it depends, and I'll kind of give you a few examples. If you are just starting out, trying to make some contributions to an account so that you're starting to build a taxable nest egg, a brokerage account nest egg, using something like a Robinhood, using something like a Vanguard account with a very low cost, really any financial institution has some investment account. And if it's self-managed, there really shouldn't be any fees attached to it. So, for example, Chase, you can open up a Chase account. There's no fees for the account, having it. You will pay a fee for whatever you invest in. The thing that you want to be cautious of when you do that is there's been a shift, I think, over the last 10 to 15 years from mutual funds to ETFs, exchange traded funds. There's nothing right or wrong per se, but with mutual funds, that model, many times they come with what's called a sales charge. And so with a mutual fund, you can pay anywhere from 1 to 5% in a sales charge, which means that if I'm trying to put $100 into this account, only 95 of those dollars are actually going into the investment and 5% are going to the sales charge. Okay. These are largely outdated, but they are still offered at some places. And generally, you don't have to pay that sales charge, is maybe the best way to say it. So using something like an ETF, that's a way to get into those investments without worrying about, is anything getting shaved off the top? So I think, again, if you're just starting out, using any of the major investment platforms, buying an ETF, VOO or VTI, so that's the Vanguard Total Stock Market Index and the Vanguard S&P 500 Index, are great ways when you're starting and the dollar amount is not excessively high. If we're talking about more wealth, so maybe we're talking about 25,000, 50,000, 400,000, whatever that is, when there's more money, the diversification becomes more important. And so in those instances, you might still choose to use those same tools that I shared. So you can still use Vanguard, you can still use Fidelity, you can still use Chase, you can still use Robinhood. Or at that stage, you might choose to work with an advisor who then can help with the allocation, whether that's somebody who's managing the money or whether somebody who's giving you advice about what to invest in. But I think, as the dollars get bigger, the advice typically needs to be a bit more tailored. But again, just starting out, most of the investment platforms are great. I like VTI, VOO as starting places for retail investment accounts.
I have also actually two questions. So I want to roll over my 401k to my Roth personal account. Does it change my contribution for that year if I do roll over?
Okay, great question. Two things. One, no. So just to answer your question outright, a rollover is not a contribution. They're already dollars that were in those types of accounts. So you can roll over your account into your personal IRA. And this might just be a kind of linguistic thing, but if you're rolling a Roth, you say you're rolling a Roth to your IRA?
And so that's the second question.
Oh, vice
Some
versa.
portion of it is
401k
Roth, some
to
portion of it is
Roth.
traditional. That's why.
Okay. So yeah, just making sure that when you roll the monies over, and there's two things. Like to like. So if it's a Roth 401k, it goes to a Roth IRA. If it's a traditional 401k, it goes to a traditional IRA.
Mhm.
Otherwise, you're doing what's called a Roth conversion.
Mhm.
And a Roth conversion is whenever you say, hey, I want to take pre-tax dollars and I want to make them Roth dollars. And you can do that. It still doesn't count as a contribution, so you're still good in that regard. But if you convert dollars from traditional to Roth, you will own the tax liability on those dollars in the year of the conversion.
I understand.
Yeah.
Thank you.
Yeah, thank you.
May I ask a question?
I got all the time in the world. I feel like if anybody needs to drop, you guys are more than welcome to, but I can stick around for a bit.
Thank you. I wanted to follow up on my previous question. So, do you have any recommendation about how much to invest in retirement versus how many percentage to invest yourself via, for example, Vanguard, any magic percentage?
The magic percentage for retirement is 10 to 20. And so let me see. Yeah, so it's between 10 and 20 depending on when we start. That number, so the thing about finance in general, like it's largely a social science. It's kind of disguised as a math equation. However, the math is helpful. And so figuring out how much you need to save for retirement, it's not that complex to do. There's a ton of retirement calculators out there. Somebody like me could help do that. But basically, you're just kind of looking at expected future earnings, rate of return. Again, you can do it on a financial calculator in 5 minutes, not even like 30 seconds, really. So 10 to 20% is a good rule of thumb. It does depend on where you're starting from and when you want to retire, but that's kind of the retirement number. As far as the non-retirement number, that one's a little bit more tricky because in theory, that money has no purpose. So unless the money either has a purpose where we're saying, hey, I want to buy a house and that house is worth $1 million and I need this much in a down payment, if we're not trying to back into a number for a particular purpose, then we're talking about saving for security, saving for flexibility, saving for something that's undefined. And because it's undefined, there's no number attached to it. So my general recommendation, and this will kind of go back to that aligning your money with your values, and the balancing of your current lifestyle. So once you've kind of met the point where you're living the kind of life that you want, you're not feeling overly restricted, but there are hopefully or maybe dollars left over, putting those dollars into a high yield savings and into a brokerage account, using both, I want to make that pretty clear too. Using both is just a great way to have the flexibility to pursue things as they become available. There is a little bit of a stigma, which I think is incorrect, about you shouldn't save just to save. I think you should, as long as you are not overly depriving yourself. Again, retirement is something we all have to be aware of it because, hopefully we're all going to kind of hit that point where we've got the flexibility to do so. But as far as saving just to save, the number is whatever you want it to be, unless there's a goal. And if there's a goal, we can kind of back into that with math.
Because when you said 10 to 20% of income towards retirement, I was thinking that, for example, if 5 of them goes to retirement account and the rest of 15% goes to the personal investment with something like S&P 500, is because that gives you the flexibility to have access to your money whenever you want. Is it good? Does it make sense, or the retirement has a huge benefit that you should?
Yeah, so typically speaking, and again, this is now speaking more generally, you typically don't want to save in a brokerage account in what sounds like it may be prematurely. And the only reason I say that is because there are very real tax benefits to investing in retirement-based accounts. And so because what I'm hearing as you're describing it is I'm almost giving myself a permission slip to undo retirement planning prematurely, by giving myself the flexibility to pull at that money. And so sometimes the kind of handcuffs are a good thing because they keep us accountable. And again, investing in retirement accounts is more efficient from a tax perspective. So I do typically recommend using at least most of your tax advantage contributions before shifting to traditional accounts for the purpose of retirement planning. And the other thing that you mentioned, which is the S&P 500, it's important to keep in mind that all of the tools that we talked about today, 401ks, 403bs, 457s, IRAs, Roth IRAs, Fidelity, Vanguard, etc., those are all the wrappers, right? So those are the types of accounts. What goes in the accounts is all the same. It's the S&P 500, it's the PIMCO Total Return Fund, it's all those different investments are typically available across the spectrum. The account is the wrapper. All right. All right, wonderful. Any other questions, thoughts, concerns that I can address while I'm here?
I